let's get into it. It is extremely hot here in Texas and my AC is broken, so I'm gonna make this short but sweet. Let's jump straight into the good news. Today's rates are higher on Nook and higher in the market than we've seen in the past few weeks and even a couple months. Let's jump into why rates went from a very solid but unimpressive 5.4% to 20%. So how does a savings rate or how does an earning rate jump 4x in one day? It's all about supply and demand, and we're going to go through that in more detail. Before we do, I'm going to zoom out a bit to the chart here that explains what I'm talking about when I say 3 months, right? So at the end of January, it started to taper off and people started putting their money into stable coins. They started saving on the sidelines and not really doing much with it. What we're here to talk about today is this little pink spike and why it's good for you, why it's good for us, and why we think it's going to continue. So before we get too deep though, let's jump back into why we're doing this, right? This is a big space, complicated space, but it's a $100 billion plus market and regular people like you and I have been left out. Consider this like stocks before Robinhood. Most people did not trade stocks before Robinhood. This gives you the opportunity to tap into these markets. What is the market? What is the opportunity? To break it down to 3 key numbers, there's $40 billion total in the DeFi lending value here. So think of that of $40 billion of people just lending, $100 billion in the market total. There's 83 million existing users that have tapped into this. So there's a good amount of existing users, but there's a lot more we think out there. And then there's 30% APY returns. So the other day we saw it spike up to 20, it can get as high as 30 or higher. And there's a really solid, steady return to make if you understand the technology and if you understand the details behind it. So the main thing that we're gonna cover today is 2 parts. So borrower demand and then a tighter lending supply. So on the borrower demand, this is people loaning money. On the tighter lending supply, this is people lending out their money. It's all about supply and demand. The main thing to kind of wrap your head around, and what took me a little bit, is when people become optimistic about the future and they want to buy stocks or they want to buy cryptocurrency, basically they're saying, hey, I'm open to more risk, let's get excited. They do borrow money. Now that sounds counterintuitive in terms of why would you borrow money if you're optimistic about the future when you want to hang on to your money and definitely not take on debt or borrow money. We always think if you're borrowing money, you're in a bad place, you owe someone money. That's not necessarily the context here. So people will borrow money when they're optimistic so they can put that money into the markets. So they will take a fee to borrow. That's okay by them because they think they'll make that back and more when they put it into the markets. So what we're talking about here is money is leaving the sidelines. It's getting into the game. They're putting it into crypto. They're putting it into the markets. This is where things heat up and things get exciting. Past few months have been relatively quiet on the market front. So what we're going to look at is a few key charts in terms of what that means when money comes off the sidelines and back into the game. So starting with the Moonwell protocol, one key chart here is the flow of money. So the flow of money can be broken down into blue and pink. Again, the blue here is people providing money, so lending supply. The pink here is APY. So they have an inverse relation. When one is high, the other is low. The past 3 months, people have been putting money on the sidelines. They were scared, they didn't know what to do with their money, so they put it into stable coins and they said, hey, I just want to earn a flat rate and not take any risk or very little risk. So they put it all into stable coins in this pool, and we watched USDC and the total value hit $20 million. It's now come down to about half of that, which means they're saying, hey, I'm going to take money out of these protocols and assume more risk and take on other things, which is great for them. For us, it's actually good because we are interested in the pink line. We want the pink line to go up, and that has definitely gone up. So because of this activity in April and May, that led to a decrease of TVL. It has led to an increase in the pink line. We can circumspect what exactly led to this decrease in the blue line, the TVL, and this increase in pink, but we do know a few things. I'm going to pull up a few graphs here. One is activity on the base chain has gone up. It's gone to all-time highs and people are using this. So it's basically a very good indicator that people are trading actively. Pretty much every number is up in terms of activity. So new addresses, total transactions. I'm going to skim through this, but What you're going to see is a lot of blue and green. A really cool thing to see here is that the number of addresses per week and retention rates have also gone up. So people are just using this more, which means people are taking money off the sidelines, putting it into the game, and we can see that. That's what leads to these rates going up. And we're just continuing to see that across all the core numbers. I'll pull up another number here, another graph here around DEX trading. DEX trading also spiked after this lull after the past couple of months. And so overall, to bring it all together, what we're basically seeing is money is in kind of tight supply again. So it's in high demand so people can make these trades. To recap, what we saw is money is in high demand again. It's all about borrow and supply. And if people are borrowing more, that's great, because that means the demand for money goes up, and when the supply is equal or lower, that's actually a good thing. So that means a higher rate for lenders. So if you've stuck around and you've kept money in Nook and in these markets, higher return for you. Spikes are good. I think we're a little bit queasy about spikes sometimes in terms of it going up and down. Don't be afraid of spikes. Spikes are actually a good thing, and we'll just take one closer look at this. Spikes really predominantly made up the high rates of these boom times. So for a lot of 2024 and then into 2025, you were seeing spikes of APY going above 30%. It might feel uneasy when it goes up and down, but again, that's not your money going up and down, that's the rate of return going up and down. In terms of your principal is always safe, this is the difference between earning 5% one day versus 25 or 30% one day. But either way, you're still earning 5% or more typically, so it's always above a normal bank account or a standard bond. So to kind of recap, spikes are good. It's all about borrow and demand. We're happy with this, and we're really excited based on the activity that this could continue in the future.